We had one wild market today where everything that had been doing so great this year suddenly pulled back. Sell. While other stocks that have seemed to have run out of oxygen suddenly sprung back to life, giving you huge percentage gains. Now, that's bad news if you own the high-flying stocks that have defined this tape so far this year, many of which are trading down even further in after hours. Companies like Microsoft, Alphabet, AMD, and they all came in red hot this week. But it's good news for a lot of the cheap old-line companies with stocks that have done nothing since December, which is how the Dow could advance 134 points today. S&P dipped 0.06%, but the tech-laden NASDAQ tumbled 0.76%. Yep, we had a whole bunch of high flyers open up big this morning, only to give it back, and in many cases more so. However, we had a host of incredibly inexpensive stocks. I'm talking about Wells Fargo, General Motors, JP Morgan, Nucor, the largest steel company in America, which is all mad money tonight. They took off as if their collective hair was on fire. Now, periodically, you get reversal days like today. Let me give a particular example because it's on top of my mind after last night's interview with Charles Liang. He's the CEO of Supermicro. Here's a tech company that put up spectacular numbers, much better than expected. Lights out. It was the bell cow for today, the one in the lead, the one that showed you artificial intelligence spending is real and it is tremendous. The trajectory of the stock, though, tells another more negative story. When the print, as we call the press release, came out last night, the stock jumped 10 points, then 12, then 15, next up 20, all after hours, mind. When I got home, Supermicro was trading up 30. I got up early to watch the stock rally some more and didn't let up until it was up $60 this morning. Sure, that's exciting. And the pin action it generated? Holy cow. For every stock with an AI connection, it was breathtaking. Stocks like the pins were flying all over the place. It was an earth-shattering strike. There was a problem, though. After we got the strike, there was no follow-through. The great roll was followed by, well, nothing. And when you know it, Supermicro finished the evening almost, yes, that was a joke, finished the, oh, just a sec, I've got one of those too. Almost where it was when it reported that monster of a number. In the meantime, we began to see a parallel levitation in another area of the market. Levitation in the banks, in the steels, and the autos. No, this time it wasn't a bowling match. What we got was good old-fashioned volleyball, a rotation out of stocks with lofty price earnings multiples and into the cyclical stocks that traded 6, 7, 10, maybe 12 times earnings. Take GM. Here's a stock that's not just historically cheap, but 4 times forward earnings cheap. I mean, the average stock is selling on 20 times earnings. That's what this one's at 4 times earnings. As CEO Mary Barra laid out a $9 earnings per share forecast for the year this morning, I'm sorry, but anytime I can buy shares in a very solvent company at 4 times earnings, I'm going to do it. And to raise the money to pay for the 4 times earnings GM shares, I will sell shares in a company that sells at 40 times earnings. And that is what I think happened today.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.